Welcome to this edition of Investment Insights. Today I have Rob and Leah with me. Welcome both. Rob, we're just halfway through the year. How are things looking?
Well, if you read the headlines at the start of the year, it was all doom and gloom, and it felt like the world was coming to an end. Thankfully, that didn't happen, and while we experienced a brief downturn in markets, things have rebounded strongly. All of the funds have experienced positive returns for the calendar year to date. Those funds with more growth assets, like shares, have outperformed the more conservative, less risky options.
Lately, investors have been focusing on the strong performance of some of the world's largest technology companies, also known as FANGs. What do these companies offer investors?
The FANGs are some of the most well-known tech companies in the world today: Facebook, Amazon, Netflix, and Google. These tech giants have been driving the strong performance of the tech sector. Over the past 5 years, Facebook grew by a whopping 680%, Amazon 500%, Netflix an incredible 1,200%, and Google 150%, so some pretty high returns. Investors are not just buying these companies based on how they look today, but on really high expectations of future success. While they have been a contributor to growth in the share markets, they've also been a contributor to volatility. For example, Netflix just announced that they added 5 million new subscribers over the quarter, which sounds like a great result. However, investors were expecting 6 million new subscribers, and the stock plunged 14% in one day. So this highlights how volatile these stocks can be. Our KiwiSaver funds invest into all 4 of these, along with thousands of other shares. The funds are diversified across asset classes, countries, sectors, and shares, so they aren't reliant on the rise or fall of any particular share.
Leah, tech companies aren't the only ones creating noise. What's happening to trade tariffs introduced by Trump?
So far, Trump's tariffs are targeting the major trading partners of the US, so that's China, Canada, Mexico, and the European Union. The current tariffs have had minimal impact on New Zealand, but this may change if the scope changes. One of the risks from Trump's tariffs is that it may spark a trade war. This has the potential to hurt global outlooks and hit the share market. It may also create a major headwind for New Zealand, which is considered to be a trade-dependent country. Politics, policy, and the potential trade war are all risks that we're monitoring closely. And while the increased uncertainty has raised volatility, the share markets are still performing well.
The government recently raised minimum wage by 75 cents to $16.50 an hour, and it's committed to raising it to $20 by 2021. How will this impact the New Zealand investment market?
Well, Tatiana, this is great news for those on minimum wage. It means they'll have more to spend and potentially save, and it may create a stimulus for the New Zealand economy. In terms of the share market here, there may be a negative impact for companies where wages are one of the main costs, like retailers and retirement villages.
Is Mercer adjusting for this?
This impact will be contained to the local market, and Mercer invests locally using active managers who will look to navigate any issues.
Mercer's KiwiSaver funds have just received a responsible investment certification from RIA. Leah, what does that mean for investors?
This means that all 7 of the Mercer KiwiSaver funds have been recognised as having a responsible investment approach. It's one of the ways that Mercer differentiates itself as being a responsible investor. At Mercer, we take an investment approach that supports sustainability and considers environmental and social factors, so we don't invest in manufacturers of controversial weapons or tobacco. We believe that responsible investing will have a material impact on the risk and return outcomes for our members and can help them save for their first home deposit or for their retirement.